Okay, so in the interest of time, I think we'll go ahead and get things going. Thank you all for joining us today. I'd like to welcome you to today's webinar discussing 5 critical things executives should do now for 2022. This is part of the CWDL webinar series on key mortgage industry topics for our clients and friends of the industry, and it's our first webinar for 2022. This one is particularly exciting as CWDL continues to be entrenched in mortgage banking and recently announced an exclusive partnership with Teraverde by way of Coheus. We're going to learn a little bit about that today. Because we're super full on content, I'm going to be quick on bios. I'd like to first welcome Jim Deitch, CEO of Teraverde. Jim's experience founding technology companies as well as being a lender himself has given him the insight to help mortgage companies improve processes, streamline operations, and increase profitability. P.S. Today is Jim's birthday. Next, I would like to introduce Mark Wilson, CPA, and founder and managing partner of CWDL. Like Jim, Mark is a former lender himself and has built CWDL to offer transformational guidance through industry-specific knowledge and a client-sided approach to accounting. Mark continues to drive forward-thinking solutions for clients and provide guidance to help them make sound decisions. Finally, I'd like to introduce Dave Fitzell, SVP and Director of Residential Lending at Meridian Bank. Dave has over 20 years of experience leading a dynamic team of experienced mortgage professionals. His economics-driven approach features a balance between value creation and risk management. We're excited to have all 3 of them with us today. Couple housekeeping items. Feel free to ask any questions in the Q&A area. If we don't get to them, we'll certainly follow up. With that, let's get started, gentlemen.
Thanks so much. I'm excited for today's panel. We've at CWDL, we've been working really hard over the past few years to drive some additional value for our clients. We're looking for technologies and try to even develop some of that internally to be able to drill down and look at some key metrics to help our clients make some better decisions. And in that effort, we had a few kind of important things we're looking at. One is it had to be mortgage specific, be able to drill down on mortgage data. 2, it had to be painless kind of from an implementation perspective. I didn't want a drawn out 3-month process to get the technology up and running. So having that ability to get something going in like 48 hours, as long as everything's set up right, was important to us. And really having the ability to create benchmarks around the data that we have to really drive value to our clients from, a 50,000 foot view has been really important to us. So that's the reason we entered into this partnership with Teraverde via Coheus, and we couldn't be more excited to do that. And I think the timing of all this is particularly important as we leave 2021 and enter into 2022. We just got back from the Independent Mortgage Banking conference, and I think like everybody on this call knows, is 2022 is going to be much different and going off in the future. So having the information that help make these decisions that we all have to do and face is really important. So with that, why don't we look at our today's agenda? I'll go through this kind of quick, high level. We're going to look at the forecast that came out of the NBA, and then we're going to go through key areas to look at in your business, what we have seen through experience and our panel has been able to help clients. And we'll go through this. And I'm not going to drill too much into the agenda, but you will see. So, gentlemen, this came out of the conference, and this is the forecast for 2022 and on. Maybe you guys can talk a little bit about this and let me know what sticks out to you. Obviously, we know where purchase business is going to be where most of the volume comes from into the future, and then we're looking at our clients' business models to see how that fits in.
Hey, Dave.
Sure. So, basically the way we've talked about this internally with our team is that we're coming from pretty much the best market we've ever seen into a new market. The way that I like to think about it is it's going to look a lot like 2019. So you take away, ultra low interest rates, the lowest interest rates in history, And then you couple that with, a lack of inventory. And I think it's going to be a pretty challenging year if you're not focused on the things that, matter, which are really the granular details, specifically focused on the purchase money market. Refis are going to be hard to come by. I think cash out will play a role, but it's definitely a purchase money market. I hear a lot of discussion around new home builders adding supply, and I think that's going to help. But then I also hear a lot of, discussion around trucking and supply shortages with garage doors and lumber prices and all those things. So I think all that bakes into a really complicated scenario that we're going to have to, really focus on the details to manage through.
This is Jim. One of the things that really struck me in talking to Mike Frattoni is he made the comment that the industry is going to have to shed about 100,000 jobs to get the balance between what 2020, 2021 brought us in terms of the need for people to that 35% down, particularly in the refi side. So as one goes through and says, how are you going to do that? Two things come to mind. One, you've got to do it based upon fact, and you've got to do it fast. Else you give back a lot of the profitability that we've all enjoyed from 21 and 22. And, David, I think you, speaking yesterday, we talked a little bit about sustainable production. So I'm going to turn it back to you and Mark just to talk about your thoughts on sustainable production.
Sure. So, the way that we like to think about, how we ultimately derive real value for the bank and also make sure we're giving a good value to the consumer and our team is that we take a focused approach on what we think our margin, what a fair profit would be. And then we ultimately back into that with our pricing. I think pricing is going to lead the day as we move into this new environment is basically to stay relevant. A lot of companies shrink their margins, which will, eat into their profits, unfortunately. But I think that's probably one of the key metrics that we've been, analyzing is saying, okay, how do we back into what we think is a fair number that's realistic based off the market we've encountered?
Yeah, what's interesting about that is sometimes we enter engagements with companies who are struggling. Obviously, 2018 was a good example of that, where margins were shrinking and people were staffed up. And we kind of take this profit first mentality in those types of engagements where, to your point, is what's the minimum amount I'm willing to make? And then which creates somewhat of a salary cap for you, right? So if you say I need to have a 10% net profit, that gives you 90% to run your business, and you have fixed costs in there, and you have to look at your business model to make sure everything else can fit into that. And if it doesn't, you have to have the courage to make some important decisions, and you need to probably do that before it's too late, right? And also look at opportunities for growth. I mean, the MBA and a lot of these forecasts come out. I think there is there are some good things in there. It's still pretty good volume available out there for those who run a well-run company. And by putting together the right process in place, you're going to win in the long run, right? There's plenty of that opportunity out there. So I don't want to paint too grim of a picture here. I just want, make sure that you're paying attention to these things. But go ahead. Product mix.
Yeah, Mark, we talked the other day, with some of those forecasts that came out, and, it's still trillions of dollars of market that are available. There's just a lot of people going after that market. And so how do we remain relevant, or what do we need to do to create an edge in order to make sure we're obtaining that amount of that market share? We've always been a purchase money lender, and being focused on that, we know that we're going to get a certain amount of the business that's available. And so we think, 2022 is going to be a great year. But there are some headwinds that, realistically, as we think about how we model that and how we staff, accordingly, to your point, making those decisions early on are going to be impactful. One of the ways we do that, Mark, if you want me to jump into the dashboard here, is this is really a great tool because it allows us to proactively manage in real time some of that data that's coming in for credit report pools and staffing, based off of, the approvals of loans and the applications taken. We can get pretty good trends to see how the market's trending. That allows us to kind of make sure in real time that we're being proactive instead of reactive, which is what this next slide's actually showing. It's showing, declining volume, which is what you'd expect. This is anonymized data. This is not our data, but I think it really tells the story of what's happening in the industry. So I think it's a great example that, we're seeing margin compression at a time of volume compression. Anytime rates run, you start to see margin compression. So we're analyzing all those things, and we're really focused on, instead of after they happen, before they happen, with this data set that we're able to get in real time.
Yeah, I think let's go. Can we go back to that one, Jim, real quick? I think what's interesting about this is, I think all data, we have access to a credible amount of data in our companies, but it's really how do you use this, and you are touching on that. But if your applications taken are 2.6 billion, but they've usually been closer to 3 or higher, and your cycle of your business, and so from application to funding, the amount of work that it's going to take to manufacture that loan. You could look at your operations staff and know if you need to staff up or staff down. So that's kind of the good thing about the mortgage industry. I always tell people is that you have new applications. You have a lot of great indicators that can help you into the next quarter if you're paying attention to them, and so you're not caught flat-footed when that happens. So that's how data can help drive and make sure that you're being profitable throughout the process. So anyways, go ahead. Sorry, Jim.
No worries. So one of the things in talking with a CEO of one of our companies, and you're looking at Coheus, and I'm going to show you just 60 seconds of how this particular use case was done by this CEO. And what he wanted to do was essentially go through and make sure that you could get a good look at what the mix was, what the volume was, and be able to see just how that happened and where the purchases were coming from. So one of the things he did was walk through the branches and the loan officers and began to look at mix. And the mix he was particularly interested in was purchases. So that's where the purchase things jump out, and you can see what they are. And he's going to hold that filter and say, show me the purchases. The other thing the CEO wanted to do was to be able to look at the Govy component of purchases. So here's the purchase mix for governments. And from there, was able to look at what's happening in the branches, but more importantly, was able then to look just into what loan officers are doing purchase business and what is the Govy mix. You can also back that off and say, show me the total mix and show me the total by the branches and by the loan originators. And that really, you can go through and jump into the detail if you wish to go into the detail. So that's just a quick look at the agility of how one can use this tool to be able to get into various looks, no keyboards, and all of this, what you're seeing is available to you literally when you put the interfaces in and connect via API, we're ready to go.
Yeah, so David, how do you use that? So, I think our clients are like many out there, it's people want high producing, high volume loan officers. Sometimes we think they're profitable, and sometimes they're not. Sometimes who you think your best performers are actually costing you money through concessions and some other things. How do you track that at your company, or do you rank LOs by profitability, by gross volume? That maybe you can walk me through that, or what are you seeing?
Yeah, so I think it's really a combination of all of those things. Volume doesn't translate into profitability, as we all know. The margin, is a big focus when you're starting to see loan officers that give, concessions or have excessive lender credits. That ultimately, trickles down into the end number or the end result. And so we're looking at all of those, and the data set that we can pull from the system allows us to do that in real time. So we're looking at all those metrics. We're also always looking to trade up. If we have, bottom producers that aren't holding margin, that aren't doing much volume, we're doing a cost analysis, and we're taking this data. It's really great to have real data in real time that allows us to get to the granular detail to allow us to make educated business decisions. Previously, we used to do this off of spreadsheets and things of that nature. And now I'm able to say, with my branch managers, when we sit down with them, we can really hold everybody accountable with accurate data. A lot of times, when you send out a spreadsheet or something like that, it can be questioned. All of this data feeds in from our Encompass system in our case. So it's very accurate, very detailed, and we can go through at a grander level and say, we need to focus on tolerance cures, which was a big exercise we performed last year in our company, and said, okay, what are the things that are triggering that, and how do we minimize those? And we successfully reduced tolerance cures by over 40% from the previous level, which was a great accomplishment for us. We were happy about that outcome, and we use the system to help with that. But accurately reporting and making sure that we hold everyone accountable, I think this system has allowed us to help us do that.
Yeah, I think one of the things I like in particular is it's not just out of your LOS. You also have accounting data that feeds back into the system that you ordinarily wouldn't have in just your LOS system, which is pretty great. What do you say to branch managers who say, yeah, I have a low producing loan officer, but they're not really costing me much money. They're just sitting there, and they might do a loan a quarter or and it might, maybe, it doesn't cost me anything, and I get an extra loan a quarter out of the person. Do you have any thoughts on that?
So we have minimum standards that we instituted to basically pull out underperformers. We feel that we've positioned them to go out and be successful. And oftentimes, if they're only doing a loan a quarter, they're not, creating any real value. We also worry about some of the efficiencies with, once it gets into our system, does that loan, because they only have this 1 or 2 loans or 3 loans, does that start to wane and clog our system? It's kind of like, if the airplane pilot, was a conversation Jim and I had once, where we talked about, do you want the guy flying your plane, that flies once a year, or the guy that flies every day?
Yeah.
What we realize is that if we gravitate and we treat our top performing loan officers well and consistently and stably make sure we give them the tools they need to be successful, that we get a better outcome. And we shed any low producers, because we know ultimately at the end of the day it clogs our efficiency, and it ultimately doesn't create any real value for the organization.
When it comes to efficiency, and David would love for you to comment on this. One of the elements that lenders look at is what's actually happening with respect to the efficiencies of processors, underwriters, and closers, and the ability to do that and to be able to literally go through and take a look at where you're getting the production, both in terms of the purpose of the loan and the loan type, and what's happening over the course of time by each individual is really important. So when you do that and you get the details, you begin to see what is the caseload of underwriters and where are they going in terms of number of cases decisioned in a given day. One can do that. One of our clients took this particular data, pushed it into an analysis of a spreadsheet, and began to go through and say, okay, there's the data. I now have the ability to get it out of the LOS fairly easily and fairly quickly, and to begin to look at that. So as you go through this and look at the scorecard, one can also go through and look at what's happening just with purchases. And more importantly, to David's point, the ability to look at what an individual branch or an individual loan officer is doing with respect to underwriter turnaround, underwriter capability, underwriter pull-through is here. So David, I'll turn it back to you and Mark.
Yeah, go for it, Mark.
No, I think it's great. You could also stack your operations staff by number of, loans they're looking at, right? You can stack that any way that makes sense for your particular organization. Maybe David, you could share how maybe you look at it at your company and.
Absolutely.
Yeah.
So what we're really focused on across the platform is trading up. And we do that with the loan officers, but we're also looking at our processing and our shippers and our, closers to say, in the event that we had to make difficult decisions, who's performing at what we consider our benchmark, who's excelling, and then, who's lagging. And it's really nice as a manager, you always have instinctive, you think that, so-and-so's great, or you think that they're adequate. Everybody kind of ranks that, I think, in their mind. But with this, we've been able to actually put the data behind it to help us make great decisions. The last thing I ever want to do is let go of somebody that's truly a superstar. We just didn't recognize that. We've been very fortunate. We haven't had, many layoffs over time, but we do use this data to really, focus on trading up. And that's something that we've embedded into our business over the years that we know that we have to do. It's just great to know that we're doing it with numbers to support it that are accurate and in real time. Working remotely, is kind of interesting because, we're always in the office. When you went remotely, you could really see in some cases who wasn't working. And that was helpful to us as we, make some of these decisions going forward.
Right. You have an underwriter who can make 10 decisions a month and another one that can make 25. And why is that? Right. There's definitely areas to look at. This is Scorecard for loan officers. So 5 metrics that really matter. Maybe Jim and Dave, if you guys, David, want to walk us through these 5 areas when you're looking at your own loan officers and trying to see which ones rise to the top and which ones kind of aren't hitting the numbers.
Sure. I think all 5 are actually pretty relevant. Volume is what drives, most of our industry discussions. Margin, is important just to make sure that, everybody's being held accountable to making sure they're pricing loans accurately. They're not making, mistakes, because a lot of times loan officers make mistakes and then ultimately the companies end up eating that. And so if we can make sure that they're communicating effectively, maybe we need to train them better, or we need to focus on a product that they made a CLTV adjustment on. It allows us to really, get into the details there. Cures and concessions in mortgage banking 2022 are a huge topic. It's a profit killer if you're not focused on these. So we work on those, all the time, as we were discussing a moment ago. Pull through, I really think of is quality. So, when I think of loan officers and I think of quality, do they bring in a good complete 1003? Because if you get, good data in, you get, to fly through your system and you have happy end customers, at the end, we're trying to keep a reputation that we're a strong purchase money lender in our market. And we want to make sure that we deliver exceptional results. And so pull through is really important. It's kind of that spoilage if you're not focused on that, because you're still paying for credit reports and time for employees, and they don't realize that revenue. So that's important. High pull throughs are critically important. And then the turnaround time, I think in order to be relevant in today's world, you better be able to close loans fast. And, because if not, your competitors are going to figure out how to do that, and you're going to lose the day. You're going to lose that deal. And with shrinking, volume, I think that's just incredibly important.
David, I think, yeah, pardon me, Mark. So David, I think your fact-based review of loan officers is really important. And I know you had a hand in helping kind of design this particular screen, which might be a little hard to read, but the first level of blue is the volume and units. The next to the right of that is the literally the margin in basis points and the margin in absolute dollars. The turnaround time, the company average is here. Individual turnaround by loan officers is here. Cures is here, and pull through is here. So you might just go through and if you wouldn't mind, talk a little bit about how you use this to coach your branch managers and to ensure that you are trading up.
Absolutely. So, I mean, volume is one of the big, components. What we've talked about with our teams is, if we have a loan officer that's falling behind, maybe they were too focused on refinance, we need to make sure they're staying on their marketing plans, that they're out, working with the right realtors and right relationship partners. So volume is something we are tracking very closely now, because what they did last year doesn't dictate into what they're going to do going forward if they're not marketing the right type of business for the environment we're in. On the margin, again, margin is so critical to all of the components, and it's easy to give it away. And I focus on margin. Every morning I start off with these screens, and Jim created really a deck that makes it quite easy to say, oh, I might need to look here today. So you'll see that, you've got different colors based off of different areas of interest. Red obviously is something you might want to look at. Average days turn time, and then on the following screen, the pull through, which are all the metrics we just talked about that are feeding into this data dashboard. We gave Coheus to our branch managers so that they had real-time data to review this information as well, and they've adopted it and enjoy working with it, because they're able to print out in real time what their team's doing. And go through that with them at their monthly meetings and biweekly meetings.
One of the elements that is in here is the ability to parse your loan originators or AEs in the TPO world into the quartiles. First is worst, fourth is best. So this is a balanced scorecard that's looking at an element of the quartile of where the lender is on volume, where they are in the quartile based upon the margin, and similarly the turnaround time and pull through. So when you look at this on a balanced basis, this loan officer is number one, and you kind of slide down to the bottom. And if you scroll down, you'll see those who clearly need some assistance, some coaching, or perhaps some invitation to go visit and work with a competitor. So David, back to you.
Yeah, it's a ranking in real time is really what it boils down to. The next screen here, Jim just pulled up, the margin dashboard is something that I look at each morning when I start my day. It basically allows us to show the active open pipeline, how that's trending, total aggregate value of the pipeline, margin at a branch level, and then more granularly. And the way that this was basically created was it allows for what I like to call an early warning indicator to things that I need to focus on at executive level to make sure we're meeting our metrics. And so you've got, your active funded pipeline. You can do that monthly or year to date, month to date, however you like to show it. I like to do it month over month because that shows how we're trending, which is again going to feed into how we're staffing accordingly and things of that nature. But just a really great tool that is probably one of my favorite screens inside of this software package that allows us to manage our business.
Yeah, David, real quick, your LOS is Encompass, right? How often are you going to Encompass at all? Are you using all the data?
Yeah, I don't really have any need to log into Encompass to manage the day-to-day business. I spend most of my time working on the business and not in that system. I review these reports. I talk to my team. I have my meetings. We're working on technology, other things of that nature to make sure we're giving them the tools they need to be successful. But this is how I and my sales managers pretty much start our day or week. Looking at the data, because it's all right here. I don't have to print out spreadsheets anymore, which has been a great time saver. And so we're focused on other things to make us be more relevant.
David, when you see a loan officer that's trending into the red, meaning that they're month over month margin is declining, or in this particular shot, their margin is below the company average. How do you help that loan officer? How do you help that branch manager for those people that are falling behind or seeing margin compression or deterioration?
Yeah, what I think typically happens is it's a mistake. It's not something they did intentionally. It's they missed a CLTV adjustment, or it was a condo and they thought it was a townhouse, or those type things where we should have been better. We should have called it in the contract. We had to change investors because it wouldn't meet some of those overlays. And then what we're doing as a team is we're going back and we're trying to coach up with training where we're bringing that to light to the team and saying, okay, don't make this mistake. We just had this happen. It was costly. We're not using this data to put anyone down. We're just using it to coach them up, really. And it's been fabulous to be able to have accurate reports to do that, because a lot of times what would happen in the past when you had an Excel spreadsheet and it didn't have the tolerance cures and it didn't have active, everything was not real time, they would push back and say, well, I think this is wrong. And there's nothing worse as a manager than going to your team and saying, you need to fix this, and then coming back and saying, well, you missed this point that was charged, or something to that nature. So this is really, because of dragging the accounting detail, it's right, it's accurate, and therefore we can use that to make them accountable. I think accountability across the platform is really the key, and this is definitely allowing us to help with that on the origination side.
Do you see, David, that since your originators and your operational team, the whole team knows you're monitoring individual performance down to the loan level, has that helped your team kind of take accountability because they know you're looking pretty closely?
Yeah, I'm very fortunate to have a great team. I think they all know that we're watching it, because they'll get a morning email or a call. I'm big on phone calls if something's wrong. And absolutely, I think it's good that they know that we're looking at it daily. We have a loan officer recently that their pipeline dwindled, and they're sitting down with our managers to say, okay, what are we going to do to reinvent our business this year, and what are the things we need to focus on? So I'm using it more for coaching purposes. I love our team. I've been very, very, very fortunate to have great partners and great team to work with over the years. But this absolutely helps us just say, okay, well, maybe we need to show this person how to go out and reinvent themselves, which is happening right now. We've had a few guys and gals that they're struggling because the market shifted, and we're pulling in some of our managers that just are exceptional at what they do, and saying, okay, these are the 10 things you need to do this week, and if you don't do these things, you're not going to be successful. So we're using it more as a coaching tool, but I think it's great that everybody knows I have the data. It's there, and I expect them to do it anyways and own it in every way, and they do. But it never hurts to be able to back it up with facts and data if you have to make tough decisions. So
yeah, you have the ability to drill down into it, which is great also.
Absolutely.
Yeah, so liquidity is always important, right? I do want to pause real quick. If anybody has any questions, I usually do this in the beginning. Please go ahead and ask them in the chat, and we'll make sure we get to that. If we don't get to it during the webinar, we'll follow up with you. Or if you just want to wish Jim a happy birthday, that's good too. But feel free to use that chat. That's why it's there. But back to liquidity. So liquidity is always important. I think forecasting is also really important as it relates to cash. I know we have some tools of that. So why don't we talk through that? How are we managing liquidity and forecasting future cash?
And one of the things that virtually all of what you see here with Coheus has been developed by clients such as David and others who have said, it would really be great if we could get clarity on closing. So what came out of this is the ability to see the three gradations of where you are as you build the month. The first is what's actually closed. It's already been funded. So that's pretty clear. The second is what CTC, or clear to close. So you can really get a sense of, if it's clear to close, it's got a pretty high probability of going. And then lastly, estimated to close. And our clients use a variety of dates. The configuration of this is fully configurable. So whether it's estimated or scheduled or some other element, by focusing on what the projected closings are going to be, it really helps be able to draw that attention to, here's where we are right now with respect to cash. Ultimately, as you look at each month, starting in February, this chart looks completely different. There's a lot of orange and some CTC on it and very little closed. So David, you might just, if you don't mind, just kind of walking through how this helps to figure where the month is, how you get to the detail, what you use in terms of how you're forecasting what's truly going to hit that closed for the month bucket.
Yeah, so it's been pretty accurate with the projected closing figures, which has, again, allowed us to make sure we have proper staffing to get CDs out on time. It's nice to be able to balance load the month if you can start to look and say, okay, these days are heavy, and we can start to spread out some of that volume so that we don't need to overstaff. So we will communicate regularly with our team and say, if you can avoid closings on Friday and communicate that a week ahead of time, we're able to shift some of those closings to Thursdays, which just makes everyone's life easier. In the CD world, everything has to go out ahead of time. And I think the biggest tool for us has been, Jim, it's allowed us to communicate some of those data points to say, okay, let's shift our closing schedule around if possible. And what we've learned is that it's typically, especially on refinances, very easy to ask a customer to close a day earlier in our world, or shift it 1 or 2 days if you tell them far enough in advance. So that's how I think we've used the screen over time.
Mark?
No, I think you hit it all. I don't have anything else to add to that. Go ahead. How are you using this screen, David?
So basically, operations warehouse, this really tells me in grades, like we've graded our loan officers or our operations staff. This is grading our best effort investors or investors that we sell to on the secondary market. It's been really good to see how much active we have in our warehouse line or our loans held for sale, and then who that volume is going to. One of the things I don't like is for too much volume to go to one investor. And so sometimes you'll see some of the aggregators, they'll price exceptionally well. I view that as a business risk. And so I want to spread that volume around. I'll talk to our secondary team if we exceed 30% to one investor and say we probably need to pull back on our locks and shift those around. I always worry about, the what if scenarios. I don't want to have too much of my lock pipeline to one person. So that's helped. The other thing that's helped is seeing who's relevant in purchasing loans and why our locks are going there more, to share with our team. There might be a niche product that they have, or there's, we're doing a lot of 15-1 arms. I don't think that's the product a lot of places, people are talking about right now, but we have a few investors that are really big into 15-1 arms. So we're focused on that as the market shifts. They're just priced exceptionally well. So that's why their volume ballooned. So you can start to see trends where there's sweet spots with what the investors are purchasing, and making sure you don't have concentration risk with one investor is how I use the screen.
That's awesome. And I think the other part is it could be the other direction. You have too many investors, and sometimes you end up not paying the right. Your margins are you get affected by that, right? So there is a sweet spot for sure. Go ahead, Jim. What were you going to say?
No, and I just to amplify that point, if you look at what's on the warehouse, and again, this is anonymized data from a variety of our clients. The different screens you're looking at, we've pulled anonymized data from a variety of different sources where our clients have said, yeah, go ahead, anonymize it, you can do that. To Mark's point, this is a look at where the investor numbers are, and you can see if you scroll this down to the bottom, you'll see investors with onesies, twosies. And the question becomes, is it worth just having that many investors that don't necessarily have the volume going to them? And what's the cost of having that? And I know loan officers in particular want to have this program or that program. But what I've seen with a lot of clients is that rule of 80% of the volumes not coming from 20% of your investors. It's really 80% of that volume's going to 2, 3, 4, and the rest of them are perhaps not as relevant. So Mark, maybe that's a good place for you to kind of pick up, and anything else you want to talk on liquidity.
No, I think that hits it. I mean, obviously you have covenants, you have other things happening when you're going in a market where volumes are decreasing. Liquidity, we've had a couple of years, we've been able to be a little bit more spoiled because it's been good, and so I think paying attention to it is important. There's the mentality of you keep spending money because you think you're one branch away from being where you need to be. You're just one great producer. I think just being true to yourself, understanding the company that you're running and where your strengths are, and really pushing on that. I think a lot of times we'll see clients that dabble in a lot of different things, and they spend a lot of marketing dollars at non-QM, and they're not really a non-QM lender, or vice versa. They're been strictly consumer direct, and although I think it's important to be able to diversify your business offering, it's understanding what you do better than everybody else, and leaning into that in a market, especially as it's changing. So, and that goes down to having every single investor out there is usually not great. We've had clients that didn't understand, they're way off on margins as they compared to their peer group. And it was because they had way too many investors and they weren't delivering enough volume to like their top 5 or whatever it was. So, yeah. And that kind of brings us to this next slide. So in a downturn in volume, what are the triggers for taking action? I think all this data that we've talked about today is this actionable intelligence, because you have the information that you need to make those decisions. So I'm going to pitch it back over to Dave because he's more interesting when he talks. But why don't you walk through this, or Jim, either one of you. But feel free to jump in here, but and kind of go through these particular topics.
Jim, you want to take it?
Go for it, Jim.
Okay,
Yeah.
I'll take a start on that. So just reflecting back on the comments from Mike Frattoni on the 100,000 people in the business. I mean, this is a harsh reality, but it's really important that the ranking of both production, operations, and support staff take place, and you do it on factual metrics. The second thing is, once you have that ranking, what do you do? I mean, Mark raised the question about the proverbial, hey, the loan officer does a loan a month or 2 loans a month. Is that really worth it? Give you an actual example of one of our clients, not David, somebody else, that went through and literally took the rankings that you saw earlier today for producers, for processors, underwriters, and closers. And some of the branch managers went to the owner and said, the CEO, and said, look, I'm getting 2 loans a month out of this person. That's great. So what that person did, what that CEO did, was looked at all the rankings and used the bottom 10% is where this individual started, and went through and looked at the pull through, looked at the cures, looked at the concessions, and then took that list to his operations team and says, is anybody on here the loan officer from hell? And the operations team said they're all loan officers from hell, so to speak. And it's because they were the bottom 10%. And what the CEO did is literally called me up and said, Jim, I did something really hard today I've never done before. I invited, a large number of our people that were in that bottom tier to move on. And I didn't stop at just loan officers, because the argument was, well, if it's 2 or 3 loans, then I'll have excess processors, excess underwriters. This individual went through and did the same thing across all of the operations, support, and production side. And 3 things happened. First, the CEO said to me, it was really hard. I mean, it was really, really hard. And it was probably the darkest day in our company because we've never done something like this performance-based. But the second thing happened the next day is people walked into my office and said, it's about time. And lastly, that small reduction really opened up the possibility of recruiting better people. Trading up, I think, is one of the words that's used, and really opened, and this is the CEO's words, opened my eyes to really variabilizing costs. So how we pay people, including operational people, to really try and variabilize that. And lastly, this CEO said, Jim, I should have done this 6 months ago. He said, if I really followed my gut, the first time I'm thinking of letting somebody go, I should do it. And in some cases, I've let people languish for years, knowing they're right at the cut line and just not really able to want to pull the trigger. So, David, love to throw it back to you, get your thoughts, and then get Mark's thoughts.
Yeah, Jim, I agree. I had to learn that lesson early on. It's always hard to let go of people. But if you have underperforming people in your team, they're ultimately dragging down your team. I personally had an experience that I hemmed and hawed around with for 6 or greater months, and as soon as I did it, it was like a world of change in our operation. And everybody thought I wouldn't do it because I had a long-term friendship with this person. I loved this person, but it was just something I had to do for our team. And so you have to make tough decisions if you're going to, excel and get better. And ever since I've done that, I haven't had any issues. It's, nobody on my team ever wants to get rid of anybody. And I respect and love that about our team. But there's times where people disappoint us. And I think it's really just something that we have to say in order for our team to be successful, which is my highest priority in any environment. In any market, I want to be able to sail through that market and not have any problems and, not miss a beat, that we've got to hold ourselves accountable. And that starts with me. So if I'm not willing to hold myself accountable, then I can't expect everybody else in our organization to be accountable. And it's not, because we're trying to be difficult and it's tough, but it's really for the greater good. So I agree with everything you just said, Jim.
I do too. The only thing I'd add, it's the old saying, fire fast, hire slow, which is easier said than done, admittedly. I think that when you're looking at what's happening in your company and there are people that are underperforming, especially in the mortgage business, you kind of owe it to the person who's underperforming to be able to be a hero somewhere else. They know they're an underperformer. At least in my experience, that's been what I've seen, and I guess that works in any industry. Is they know that they're average and maybe they can be above average somewhere else, and so sometimes it's good for them too. And keeping an underperformer who, especially in any position, but a loan officer, they forget their password, they need help, pricing a loan, like if they're unless this is their career, and they're producing that those are the people that y'all want, and chasing loan officers who underperform don't do any good. And I know why independent bankers do it. It's because ultimately that's kind of your customer. A loan officer is your customer. So with that mindset in place, you want as many customers as you can get. But sometimes they're costing you more than they're worth. So, I come back to this idea of having the courage to know that and know which one of your customers you should really keep and which ones you shouldn't. So, yeah.
Well, and I've been impressed with David by being so transparent and sharing really all of the information that we did today, whether you do it with Coheus or you do it with some other methodology. Being transparent and letting people see where they stand, where they are ranking wise, it is just the ultimate in my mind of being honest with your team and making sure that, to David's point, he's got some minimum standards for everybody. And if someone isn't making those minimum standards, coach them up, do everything you can to help. But ultimately, to be part of any team, you've got to meet the requirements. So that takes us into a look, and Mark, if it's okay, maybe we can talk a little bit about Loan Vision and just talk how you can kind of grab some information from both the accounting system and the LOS, if that's okay.
Yeah, no, and I think when we were trying to define systems, that was the biggest part that we're trying to figure out, is marrying your LOS information with the accounting information, and be able to pull that back and forth really helps. I mean, from EPOs and all these other items that will run through your P&L that isn't always entered into your LOS, really helps you find out who your performers are, which branches are really doing well, and also helps you be able to predict a little bit better. So let me, I think pitch it back to you, Jim. Maybe you can walk through this slide a little bit and tell them what we're doing, how that information gets in here and how to use it.
Yeah, so we're pulling information in this case out of both the LOS and in this one, the Loan Vision system, and it's reading the structure of how this lender is configured in Loan Vision. I'm looking now at the net income by branch and by loan officer. So I'm taking this and working backwards. I'm now pulling, show me the top 13 loan officers and where the branches are that they've come from. So I can do that. I can also look at the bottom performers. So now we're going through and seeing the branches and the loan officers that may not necessarily be making us money. And this is coming directly out of the GL system. So in this case, when you're talking about ranking, and to David's point, it's not just production, it's not just mix. It's truly where one is with respect to the performance and the ability to rank both the highest producers as well as the folks that aren't producing any income. And in this particular lender was able to use the GL to produce both branch as well as loan officer level P&L. And that really helps this particular lender go through and identify who is really doing it in terms of not just volume, but in terms of contribution to the bottom line.
Yeah, which is really powerful. We're at a click. You're not trying to pull this out of two different systems and running in Excel. It's just right there at your fingertips, which is great.
Then Mark, lastly, just counterparty risk and looking at the ability to go through and analyze the credit box. Just take a quick look, and this is a use case from one of our clients that was pretty interesting from my standpoint. So what they did was go through and said, show me my loans originated, my pipeline, and I want to look at the credit box, meaning I want to look at everything 659 and lower based upon the FICO distribution, everything over 95 and everything over 43 on the DTI side. So I can get a sense of what that looked like. So there's what it looks like for all of those loans that were done during that period of time. And if you're going to go through and think about where you're going to QC, where you're going to spend your time, where you're going to look at where these loans that might have the highest degree of risk, these are the loans that are probably worth a quick look, maybe pull the files, make sure the data is correct. Not going to show you here of how you can do that within the Coheus system, but essentially you can scrub all this data and identify those loans that might be potential problems. Going back to the repurchase elements, say 5-6 years ago, I did a lot of work, expert work on that with about $52, $53 billion of repurchases. And invariably, the cause of the repurchase was usually 95% of the time bad data. The data wasn't right. It was not causal to performance, but it was a violation of the contract, and a lot of those loans were bought back. So that's a quick look at data integrity. And Mark, I think it would be great for you to kind of summarize, and
sure.
If there's any questions, feel free.
Yeah, it's funny. We internally at CWDL, we always have like a background internal joke about data hygiene. So we always say the data is critical, and obviously we're making decisions based on what that data tells us. So obviously going into the system is really important. So that was great information. No, I think and I don't see any questions coming in. I want to make sure I give everybody an opportunity to ask a couple here if you have them. We have a quick, I don't know, a 3-sentence survey or something coming up here in a minute. If you guys would be so kind to go through and at least answer our survey. We really want to make sure we're providing value through these webinars and to our clients and industry partners. So please take a moment to answer that and let us know if you felt like this was a worthwhile topic, you liked what you learned today, and if there was anything else we could help you with. Also, if you're interested in learning more about Coheus, please let us know. We'll obviously put you in touch with the right people to do that. I see Casey's popping back on here, so I'll turn it over to her. Thanks to our panelists. Thank you to you both for joining us. I really appreciate it. I got a ton of value out of it. I even learned more about the system today, which was good for me. So go ahead, Casey.
Yes, thank you all so much for joining and chatting through that today. Like Mark mentioned, really valuable insight and information. I know so often we get CEOs and CFOs asking us to really help them identify leakage and areas of opportunity to kind of trim down and at least have really solid data. And you guys have done a remarkable job at that. We're really, really happy that we're partnered with you. And David, thanks for taking time to share some of your personal experiences.
Absolutely.
I'm sorry. Thank you. So yeah, everybody on today's webinar will get a recording. Keep an eye out. It'll either come today or tomorrow. And then as Mark mentioned,
we'll also send out the slide deck too, if they would like to look through that.
And we will also send out the slide deck. And then Mark mentioned we have a survey at the end of the actual webinar. If you guys would be so kind as to add insight there, we take that and hopefully continue to refine what we're doing and bring you really valuable information. So thanks everybody so much. Happy 2/2/22, and Jim, happy birthday.
Thank you.
Happy birthday. I'd sing, but that would not be a gift. So
All right. Thanks very much. Thank you.
All right.
Thank you,
you
guys.
guys.
Take care.
Bye. Bye-bye.